Hi there. Welcome to Trading Day. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. U.S. President Donald Trump says the U.S. would postpone strikes against Iran's energy infrastructure after productive conversations with the country. The president suggested the U.S. and Iran could jointly control the Strait of Hormuz, which he says could be open very soon if negotiations are successful. Donald Trump says the U.S. would give negotiations a 5-day period. The head of the International Energy Agency is warning that the global economy faces a major threat because of the Iran war. Fatih Birol says the situation is very severe and no country will be immune to the effects if the war continues. He says the crisis in the Middle East has had a worse impact on oil than the two oil shocks of the 1970s combined, and a worse effect on gas than the Russia-Ukraine war. And 2 Air Canada pilots are dead after an Air Canada Express plane collided with a fire truck shortly after landing at New York's LaGuardia Airport. The pilots were killed on impact. There were 72 people aboard the aircraft, and 41 were taken to hospital, with many in serious condition. Air Canada now says it is cooperating with the investigation. And we're watching the TSX today up 1.5% at the moment, making some gains after a bit of a rough week last week. We're also seeing markets in the U.S. mostly in the green today, a bit of a reversal from what we've been seeing recently. The S&P 500, Dow Jones, and NASDAQ are all up by more than a percentage point at the moment because of these developments coming out of the Middle East. U.S. President Donald Trump saying there may soon be an end to this conflict, and you can see markets reflecting that optimism today. Oil prices dipped after U.S. President Donald Trump announced a pause on attacks on Iran, citing constructive discussions with Iranian officials. But Iranian media states no talks have taken place. So here to discuss that and today's markets is Jack Manley, global market strategist at JP Morgan Asset Management. It's good to have you join us. Thanks so much.
Thanks for having me.
So we're hearing two different things from both sides. I wonder how you kind of look at that and really look at the markets and how investors should be looking at these two sides, hearing what people are saying and trying to read between the lines.
Yeah, I mean, look, there's no inside baseball over here. I cannot admit that I have some sort of insider information as to whether or not these negotiations are actually happening. But what I think is important to realize, right, given what's happened in markets today, whether you're looking at stock prices or at oil prices, is that the global market is just desperate for this thing to wind down and wind down relatively quickly. You wouldn't have seen such an incredible pop higher in stock prices, such a notable move lower in oil prices if there wasn't this real hunger for this thing to wrap up soon. And when I'm speaking to investors, when I'm speaking with clients in the United States and up in Canada, one of the biggest risks that I see right now to the outlook is that there is a very significant dislocation in the way the crude oil is being priced over here in the Western Hemisphere and over in the Eastern Hemisphere, particularly in the Middle East. There's a large difference between the cost of a barrel of oil in Canada or in the United States compared to a barrel of oil coming out of Saudi Arabia or Kuwait or Iraq. And because oil is traded globally and priced globally, this dislocation shouldn't exist. If the conflict lasts longer, there is real upside pressure building in Western crude prices, even if things don't get any worse. I think further underscoring the importance that this thing winds down sooner rather than later, again, explaining some of the enthusiasm from markets in response to this news.
You say this dislocation shouldn't exist. Why is it so unsustainable, do you think?
Well, oil in theory, oil not in theory, oil in practice is priced globally because oil is consumed globally, but also because, putting aside the disruption in the Strait for a moment, it is very easy to transport globally, right? Oil is a liquid. You pump it into a tanker and you send the tanker out. There's no real complicated technology, no additional logistics required to move that oil around. And as a result, when you're looking at global energy markets, the benchmarks around the world, whether you're looking at WCS, WTI, Brent in Europe, or some of these Middle Eastern benchmarks, they typically trade around a central tendency. with the difference being whatever that incremental risk premium might be, and then also the costs associated with additional refining. Right, WCS always trades at a discount relative to WTI because it's heavier, requires more refining before you turn it into a distillate. We are talking about maybe a $10 difference in prices globally, a $5 difference in prices globally. What we're looking at right now, though, is a $30, $40, $50 difference in prices globally. And that, Lindsay, is what I don't believe is sustainable over the long run.
Interesting. You also mentioned as well that North America is kind of insulated from these costs due to energy independence. How does Canada factor in with all that?
Canada, like the United States, is energy independent, which is enormously helpful. Both of these countries produce more than they consume. They export more than they import. Whatever they're importing, I like to say, is typically out of convenience rather than necessity. It's because the supply chains there work in favor of importing, not because there isn't enough crude to go around. The other thing that I think is very important to point out here is that both of these countries, right, Canada and the United States, although you can list a handful of countries after them as well, have become a lot less crude oil intensive over the past 10, 20, 50 years. Yes, we are dealing with the greatest shock to crude oil markets we've probably ever seen in history, but both of these economies require a lot less crude oil than they did in the past to produce a unit of GDP. Our engines are a whole lot more efficient, meaning we have to use less of this stuff to result in the same output. Both of these countries have benefited from a boom in natural gas production. It is abundant, it is cheap, and unlike crude oil, it is priced locally. So prices for natural gas in the Western Hemisphere not being impacted by what's happening in the Middle East, and that's structurally how it's supposed to work. These things help to support these economies, keep them insulated from an energy shock, and as a result, in my opinion, the risk to growth in particular is much more diminished than what you would have seen in the 1970s.
Interesting. I mean, given what we're seeing with the markets today in reaction to everything we're seeing coming out of the Middle East, it's a bit of a reversal for a lot of things, not everything. Gold is a separate story. It's very interesting. But when you look at the market reactions today, do you think that this delays any rate cuts that the Fed signaled for later this year? Or what do you think the Bank of Canada and the Fed are maybe thinking as all of this unfolds? Yeah. Or is it too early?
It's been a very difficult ride for both of these central banks. And while I don't think you can claim either one of them has managed policy perfectly, they have done a remarkably good job of managing policy, given all the curveballs that have been thrown their way over the past several years. Both banks have proven themselves to be reasonably data dependent. Both banks have proved themselves to not be reactionary. And both banks came out just last week during that critical Wednesday when we had both of them meeting at the same time with commentary that said, effectively, look, what's happening in the Middle East is not particularly good news for the macro outlook. It won't be great for growth. It won't be great for inflation, but it's not going to make such a large impact, nor will that impact be extremely long, that we will have to make any sort of adjustment to the pace in monetary policy. So when the Federal Reserve put out its summary of economic projections last week, as it always does, every March it's a quarterly thing, they reaffirmed what they told us back in December, which is one rate cut this year. Still think that's a reasonable thing to believe in. And I don't believe that anything that's happened overseas has fundamentally dislodged the thinking around monetary policy in either country. They're going to be looking through this disruption.
Just in our last minute here, you argue markets will stabilize with no major damage. What do you think a normalization would look like to you?
Hey, that's an important question because it is very easy to forget that the not so distant past wasn't a great environment for risk markets either. We started off the year with regime change in Venezuela. Not too long after that, concerns around an invasion of Greenland. Not too long after that, a rout in Japanese debt markets. Then we have precious metals exploding, a potential rout in private credit, software stocks coming under pressure. The U.S. equity market in particular was not in a wonderful place before this conflict in Iran kicked off. While I do have to acknowledge its resilience, it wasn't down a whole lot. It's not like we were up 15% before this thing started. And so once the dust does settle, once we go back to realizing that there are other things more important shaping our own domestic economies, domestic capital markets, we're going to be returning to a period of additional volatility and a whole lot of questions around the viability of earnings longer term.
Everything you just mentioned sound as though they should happen over the span of a couple of years, not just a few months. But this is the world we're living in. Okay, Jack Manley, global market strategist at JP Morgan Asset Management. Thanks so much for your time. Appreciate it.
Thank you.
Coming up, as oil prices dip today, we'll see who stands to win in this situation with our next guest. That's right after this. A possible de-escalation in the Middle East conflict rippled through markets today, with oil falling, stocks rising as U.S. President Donald Trump said he would postpone strikes on Iranian energy infrastructure. Here to talk about how the U.S. and Canada could stand to win in this situation is Rob Thumel, Senior Portfolio Manager and Managing Director at Tortoise. It's good to have you join us. Thanks so much.
Thanks, Lindsay.
So is what we're seeing today maybe a bit of temporary relief or signs that markets are mispricing the risk of kind of renewed escalation here in the Middle East?
Well, if we do get the Strait of Hormuz open and ships start to flow through, I think you'll see more physical barrels back on the market, and you will see oil prices continue to come down. So we'll see how it plays out from here. I mean, ultimately, the Strait at some point in time will become a little more free-flowing, and that will cause the oil price to come back to a more realistic or reasonable level.
Do you think it'll look the way it did before, though? Because Iran media is saying today that even if Hormuz reopens, it won't look the same as it used to in terms of maybe how much tanker traffic is moving through there.
There could be, and that's always a possibility. And obviously, the geopolitical risk premium in oil is going to reflect that. It's going to go up. It's going to be higher. For oil prices, the floor is going to be a higher floor than what it's been historically. But hopefully the risk of, I've seen quotes out there for $200 oil. Hopefully those can go away. Do we need to stay in the $80 to $100 range? Possibly. I would rather see us come back down into the 70s and even what the future curve says, and even potentially into the 60s by next year, because I just think that's better for the overall global economy and the domestic economy.
Okay, let's talk now about Canada and the U.S. and how these two countries, our two countries really, can stand to kind of win amongst all of this. You believe they can play the role of reliable suppliers with natural gas, is that right?
Yeah, that's kind of the story that's getting lost here, Lindsay. Is international natural gas prices are up over 80%, and in Canada and the U.S. they're up a little over maybe 8% or something like that. So there's a lot of low cost natural gas in the U.S. and in Canada collectively in North America. Europe needs more energy. It needs more natural gas. It needs more liquefied natural gas. And the U.S. and Canada can be the reliable supply source for that natural gas for not just weeks and months, but for decades to come.
Do you think that should be where the focus is, specifically Canada, because obviously we're in Canada, but should the focus be not so much on oil and more so on natural gas?
Well, oil's still relevant, but I do think that natural gas has a much larger role to play and will play a much larger role globally over the next several decades, just because of the need for increased electricity demand, both in the U.S. but as well as globally, to support AI as the next industrial revolution. So yeah, I do think that the natural gas is an excellent fuel supply source to generate electricity, and will help industrial revolutions like AI well into the future.
How much of a strategic advantage do you think the U.S. and Canada have from being energy independent during times like these with conflicts like this?
Oh, it's huge. If you think about it, I mean, obviously, one of the strategic advantages that you highlight is one of the winners is going to be who can provide the lowest cost, who can provide low cost energy, and the U.S. and Canada can do that. The U.S. and Canada are some of the lowest cost energy producers in the world when it comes to natural gas. And so if you think about what is natural gas used for, well, obviously it's used for heating, but it's also used for electricity and industrial activity. And these are really important economic engines behind economies. And so if you can be the low cost producer of that fuel supply source, that's an absolute competitive advantage for a long time.
You mentioned energy security. So which parts of the global energy infrastructure are most vulnerable right now, do you think?
Yeah, well, I think we're seeing it, right? I mean, clearly the Strait of Hormuz it's become very clear how important that is. That's obviously very vulnerable, and remains that way. And you've seen what happened in Qatar with the LNG facility getting struck by drones, and the impact that's had on the global LNG market. So, yeah, I think all infrastructure is frankly really important and really critical, and all is vulnerable. But the good news is in Canada and the U.S., collectively those. In the U.S. especially, the U.S. operates one of the largest energy infrastructure networks in the world. It's very secure. Canada is the exact same way, very secure energy infrastructure network of high-quality operators of oil and gas pipelines.
You do have some energy stocks that you wanted to highlight, at least ones that you like right now. We can go through those. We'll start with ExxonMobil. What is it that you like about this one?
But Exxon, yeah. So if you think about Exxon, with higher prices, higher commodity prices, Exxon always benefits. But you don't just buy Exxon because of the higher commodity prices. You buy Exxon because of its exposure to really what's really happening, which is fueling the global economic expansion. And so Exxon is participating from an oil perspective. Obviously, they're adding to the global oil supply with its development in Guyana. They're actually starting up their Golden Pass LNG facility, I think, any day, which will help export liquefied natural gas to Europe and help alleviate some of the higher costs there, or bring those costs down a little bit. And then Exxon's doing some interesting things with carbon capture and some infrastructure that they're doing around carbon capture. And then I wouldn't be surprised if you see them do something with AI down the road. They haven't really announced anything yet, but I think that'll be something that'll be interesting to watch as well.
And on the topic of natural gas, another pick for you is Cheniere Energy. I'm not sure if I said that right, but what is it that you like about this company? Tell us about it.
Yeah, Lindsay. So Cheniere is a longtime holding at Tortoise, one of our top holdings in our mutual funds. And we like Cheniere because they're the largest exporter of liquefied natural gas in the U.S., and the U.S. is the largest liquefied natural gas exporter in the world. And so if you look at where European natural gas prices are relative to the U.S., European prices today are 5, 6, 7 times higher. That's a clear indicator that Europe needs more natural gas and needs more LNG exports from places like the U.S., and Cheniere is really well positioned to expand its LNG infrastructure or its LNG infrastructure platform, I guess, and benefit from growth of that in the future.
Okay, we will leave it there because we're out of time. Rob Thumel, Global Market Strategist at J.P. Morgan Asset Management. Appreciate your time. Thanks so much.
Thank you.
And after the break, architect Bjarke Engels talks to Bloomberg about how economic uncertainty, politics, and risk shape the future of architecture. Stay with us. That conversation is next. Bjarke Engels, founder of Bjarke Engels Group, has designed some of the world's most ambitious buildings, from Google's campuses to climate defenses for New York City. He believes architecture should exceed expectations and give something back to a city. The founder sat down with Bloomberg to discuss how economic uncertainty, politics, and risk shape the future of architecture.
I like it when a building exceeds the expectations. And in addition to solving what it is built for, it also gives a gift to the community it is part of.
Every building we didn't do is a missed opportunity.
We do everything from lamp designs to new cities from scratch. Here in New York, our first building was a building called the Court Scraper. And 25 years ago, our first building was the Copenhagen Harbor Bar. We've designed a museum that is a bridge spanning across a river in a sculpture park. And we've designed the home of the Lego brick. And we try to imagine an architecture that would be as inviting and engaging as Lego is itself. So you can climb all the roofs like public playgrounds without a ticket. This is sort of the library where we somehow archive and store the sketch models for every project. I met Stephen Rockefeller, and they were involved in creating the Rose Rock Financial Center in Tianjin. This is a 3D printed performance pavilion we've created in Austin. We are in the process of finishing this very large project that started right after Hurricane Sandy, which we've nicknamed the dry line. Essentially, imagine the high line that will keep Manhattan dry when the next Sandy comes. So this is essentially the waterfront of Lower Manhattan. We are realizing this entire East River portion is currently under construction, like maybe a third of it has already opened to the public. But the south tip, you don't really have the real estate to protect the city. So we made a study for the city where we looked at expanding the south tip of Manhattan with a little more park, and this little zone of green is what will protect the city. The last, let's say, 6 years have definitely not been a feast for all our traditional work. Because it's been like this perfect storm of one catastrophe after the other. And now lately, the constant threat of tariffs means that no one wants to commit any kind of long-term capital. So how have we survived the last 6 years? Around 2020, I made this kind of little bucket list of 5 projects that we had never done. And we kind of committed to say that every year we should be willing to over-invest 25% of our EBIT in trying to win one of these. And interestingly, just 2 years later, we won our first airport, the airport of Zurich. It's going to be the largest timber building on Earth. We won the Philharmonic in Prague. We're doing the Vegas Ace, and we're creating their home on the Strip. And the good thing, all of these kinds of projects are a little bit less dependent on the typical economics, because they are projects that need to happen. So in that sense, happily, we have survived actually doing the work we love. I studied at art school, sculpture, painting, and architecture. In the first, let's say, decade and a half of my career, when we would show up in the newspaper, it would always be in the cultural section. And I had a kind of wake-up moment. In January 2020, I was traveling in north of Brazil, and I ended up giving a talk making the argument that the ecological value, if preserved and protected, would also represent in long term the greatest economical value. And of course, the president at the time in 2020 was Jair Bolsonaro. That photo of everybody in the meeting quickly gets cropped to me and Bolsonaro standing next to each other. And then all of the media explodes. It's almost like guilty by association. And it kind of shocked me that anyone would care who I met with. And in the end, I kind of came to the conclusion that I would like to be involved in important issues. I might actually have real insights for the powerful decision makers to actually make the right choices. And I think the lesson is that you have now graduated from the cultural section to the grown-up section that's about politics and economics. I cannot imagine anything more rewarding than literally creating the world of your dreams. Running a business is the necessary side effect. I need a lot of skilled colleagues, talented human beings to make all this happen. And as a result, we are now like more than 800 people working together. I would hope that our buildings somehow make people aware that your physical environment, it can also create this opportunity. This idea, allowing people to realize that the world can be more. We actually, as human beings, have the possibility and the responsibility to make sure that it actually does fit to the way that we would like to live our lives today.
Coming up, hot picks. We will zero in on 3 U.S. midcaps to keep your eye on right after this. Donald Trump says the U.S. will postpone strikes against Iran's energy infrastructure after productive conversations with Iran. The president suggested the U.S. and Iran could jointly control the Strait of Hormuz, which he says could be open very soon if negotiations are successful. Trump says the U.S. would give negotiations a 5-day period. Shares of Sony are trading higher after a report from Bloomberg that the entertainment giant is nearing a roughly $1 billion U.S. deal to sell a majority stake in its home entertainment unit to TCL Electronics. The transaction would build on a previously announced joint venture that would see TCL take a 51% stake and oversee production of televisions under Sony's Bravia brand. And Berkshire Hathaway is investing $1.8 billion US into Tokyo Marine Holdings, expanding its presence in Japan's financial sector. The investment will give the firm a 2.49% stake and will establish a strategic partnership spanning reinsurance and global deal-making. The agreement includes a 10-year collaboration and limits on competing partnerships in its early years. And we're seeing a reversal in the markets today. The TSX up almost 2% at the moment. We saw a lot of losses last week for the TSX, so interesting to see it rebounding today. And we're seeing a similar story in U.S. markets. The S&P 500 is up by more than a percentage point. Same with the Dow Jones and the NASDAQ. Investors weighing what's happening in the Middle East as oil prices are dropping. We can see stocks and bonds rising today. It's time now for Hot Picks, and today we are zeroing in on 3 mid-cap stocks. We were joined earlier by Ryan Modesto, CEO and Portfolio Manager at I2I Capital Management, and we kick things off with Badger Infrastructure as his top pick, an excavation services leader with operations across North America. Take a listen.
This is a company that has infrastructure in their name, so they're benefiting a bit from that AI infrastructure build-out. So the nice thing about this company is most of their fleet, all of their fleet is on wheels, so they can move to wherever the demand is. And this company, they're seeing demand in the US currently, and that's where they've moved a lot of their fleet towards. And about 88% of their revenues come from the US side of things. So they're already levered to good growth on the US. They're levered to kind of the infrastructure and AI build-out play in US as well. They've been taking a bit of a hit or seeing some weakness recently on some CapEx spending that the company is doing. Markets don't like that in the short term, but longer term, we think it's good. They're obviously seeing the demand. They're leaning into kind of that demand they're seeing in the US, and their return on invested capital is about 11% annually. So any of that kind of additional growth that they're doing, investment that they're doing in the capital spending, we think it's a good thing because they're going to capture kind of that 11% return over time.
When it comes to risks, like you mentioned that capital spending, obviously a lot of investors, we've been seeing that with so many companies who are coming out with this spending, investors are pulling back a bit, a little bit hesitant about that. Is that one of the biggest risks for a company like this, or what other risks are you watching for Badger Infrastructure?
Yeah, for sure. I mean, a weak economy means you're going to pull back on capital spending plans at the company level. Obviously, a recession, everybody starts to kind of clutch their pennies and their wallets a bit tighter. That wouldn't necessarily be a good thing for Badger. But on the other side of that, the AI investment seems to be kind of bucking that trend regardless of what's going on in the broader economy. So you could have a scenario where you have capital spending pulling back in other areas of the economy, but the AI investment trade still kind of keeps going. And Badger, I mean, not all of their business is exposed to this type of trend, but it should be a tailwind for them as well.
Okay, next up in terms of hot picks, this is an independent power producer out of Alberta, Capital Power. What is it you like about Capital Power?
Yeah, so Capital Power, similar with kind of that tangential exposure to AI happening in the US, there's a lot of required demand for energy to power these data centers. You need a lot of energy to power them. So the independent power producers are kind of stepping up to fill in that gap for energy demand that's happening. And Capital Power is doing exactly this. They're stepping up and working on an agreement to help the build out of a data center in Alberta. And they've also recently signed a $3 billion joint venture with Apollo Global to go seek out acquisitions in the US to kind of capture that demand that's happening in the in power demand overall. So that's good. And they've recently had their investor day, and they're targeting annual growth out to 2030 in adjusted funds from operations in the 8 to 10% range, which is a nice growth rate here. In terms of valuation, trading at 20 times forward earnings, which isn't horrible valuation. It's not maybe not the cheapest, but we don't view it as a very expensive valuation as well, with 4% dividend yield and a lot of transparency and visibility into their future revenue and cash flow profile, which kind of justifies a bit of a premium valuation here as well.
Okay, and lastly, WSP Global. Tell us about this one.
WSP is an engineering services firm. And the big story here is they made an acquisition of a company called TRC in the US, and TRC focuses on the power and energy segment, which, as we were just discussing, has a lot of demand right now because of everything that's going on with that AI infrastructure investment. So this acquisition is really just straight out of the playbook for WSP Global, where there's kind of a new growth area, and they go make a big acquisition of a company that kind of gives them like a premier position in that space. And we think they're doing that again with TRC. It's providing a long-term growth platform for them, but also should boost their growth in the short term. Meanwhile, this stock's trading about 18 times forward earnings, which going back to 2017 is a bit of a trough multiple for this company. So we think from a valuation perspective, WSP looks quite interesting.
It's so interesting when we're talking about these mid-cap companies, because obviously what we've been hearing since the beginning of the year in terms of small caps is this is the year for small caps. Do you think, and I know 2026 changes rapidly, there's so many developments every day, but do you think so far this might be the year for mid-caps and it would be a good time to be investing in mid-caps for that reason?
For sure. In fairness, we probably said that last year as well, but if the geopolitics can get out of the way, we think it's a really good setup for the small and mid cap space in general. They tend to be a bit higher growth, tend to be cheaper than large cap peers as well. So we think there's a lot of potential in this space. And
is there anything else you're watching for in terms of like potential rate cuts or rate hikes that could affect mid caps?
No, that they will see something. So our kind of view is that rates will sort of slowly come down over time, but we think we're kind of past the rate cut story. We think was more of a 1 year ago, 2 year ago kind of story. Yes, if you get rate cuts, it's going to help things, but we don't think that you need rates to come down to drive the mid cap space higher. It won't hurt, but we don't think that's kind of the main piece to make it work. It's just kind of fundamental earnings growth, and with a decent GDP economic growth backdrop, we think that these companies will do quite fine.
Okay,
barring the geopolitical situation getting out of the way.
That was Ryan Modesto, CEO and Portfolio Manager at I2I Capital Management. Okay, let's take a look now at what stocks are trending today. We'll take a look at some of the TSX leaders. The TSX seeing some gains once again, and here's some of the big movers on the TSX today. NGX Minerals up about 10%, just over 10%. This is the most for this company in 5 months, as it provides some positive drill results from a copper, gold, and silver project in Argentina. Another company doing quite well today, Aritzia. We're watching this one. It's up almost 7%, more than 6% at the moment, showing continued strong sales performance today. Investors obviously liking what they're seeing when it comes to Aritzia and its sales performance. We'll take a look at a couple of others, some of the laggers on the TSX, or not laggers yet. We're going to take a look at some mining and gold stocks on the TSX. This is interesting considering the price of gold has been plummeting today, but you can see America's Gold and Silver Corporation is up by almost 12% at the moment, and K92 Mining also up more than 8%. Now we'll look at the laggers, because there are some on the TSX as always. Vermilion Energy is down quite a bit. Obviously, we're seeing the price of oil dropping substantially today after Donald Trump's remarks this morning. Vermilion Energy on the TSX down by more than 5%. Methanex Corporation down by more than 3%. And International Petroleum is down by almost 5% at the moment. Also watching Air Canada, obviously some real tragic news coming for Air Canada today out of LaGuardia Airport after a crash there, after an Air Canada jet ran into a truck on the tarmac. But Air Canada's stock is up today almost 3% at the moment. Sony Group is another company we're watching closely today. As we've been telling you, Bloomberg has reported that Sony is nearing a $1 billion deal to reshape its TV unit. And you can see Sony's up almost 3% at the moment. Coming up, while oil prices dip today, could this be a moment for Canada? We'll find out with our next guest right after this. Stay with us. While markets continue to react to the ongoing conflict in the Middle East, our next guest says this is not the time for Canada to build more pipelines. Here to share his in-depth analysis on Canada's role in the global oil market is Werner Antweiler, Associate Professor specializing in energy economics at the University of British Columbia's Saunders School of Business. It's good to have you join us. Thanks so much.
Hello.
So I feel as though we hear a continued push from within Canada to constantly build more pipelines. You don't think we should be. Why is that?
Well, today's prices are no indication where prices are going to be in 5 years from now or 10 years from now. And when investments are made in the energy sector, they're made for generation. So you kind of need to look at the outlook for the next 20, 30 years. And that is looking at factors such as demand and where supply is available elsewhere. And this is what determines the investment decisions, not the prices that we see today.
It's interesting because with this conflict in the Middle East, it seems as though there would be more demand for Canadian oil just because of where we are, even just geographically. But you don't see that in the long term, I guess is what you're saying.
That is really the question about where we see the long term in a few years from now. If you look at future markets today and the price of oil, even for delivery a year from now, the prices are well below the high spot prices that we are seeing today. The markets seem to believe that the current turmoil in the Middle East will eventually subside and return to a more normal price level that is around $70 a barrel by next year at the same time. So what that indicates is that the decisions that would need to be made for investments are based on these long-term prices that would persist over the next number of years, even decades, and certainly not the extremely high prices that we're seeing right now. And even the prices that we saw in 2022 during the energy crisis then, when Russia invaded Ukraine. Again, these are not the prices for which one builds more infrastructure unless it is actually a question about energy security for an individual country.
You say, though, that there is a stronger business case for enhancing the existing TMX pipeline. Can you explain?
Yeah, so there are different pipelines that exist in Canada, and the expansion that has been built that became active in 2024 here in BC has been delivering to international markets in Asia, and there is a potential actually of utilizing it better. So if there is an existing pipeline that can be upgraded for some investment, that actually can enhance the throughput of that existing facility and deliver more oil to international markets. So this is what is low-hanging fruit of change. That is a business case that can be made. And that is quite different from building a new pipeline with a new right-of-way in a new location with new export terminals and accompanying infrastructure. So these are very different propositions, one that has very likely a stronger business case than building completely new infrastructure.
It's interesting, too, when you talk about the investments that would need to be made for many of these pipelines, like investors would need to be interested in, for example, this latest pipeline project that would bring a pipeline to Alberta under the Major Projects Office of Canada. But you're saying we're not really seeing that interest from investors. Like, can you elaborate on maybe why we're not seeing that? Does that have to do with the long-term price of oil and how feasible it would be?
That is precisely the issue. There are two factors to consider here. One is the long-term price of oil, because oil is traded in spot markets and not in long-term contracts. So you can lock in future prices and then help amortize this project as is customary for liquefied natural gas. And so these pipelines are built under very different circumstances than oil pipelines. For oil pipelines, it's really important to understand what is the long-term equilibrium price in the world markets. And most experts would put that in that level of 60 to 70 US dollars a barrel and not lofty prices that we're seeing today. And the second factor is the cost of building this pipeline. And if it's a new right-of-way and new infrastructure along the way for the export terminals, then it needs to translate into a price difference for the oil that is larger than the cost of actually shipping it there. Now, when we're looking at shipping oil through the Trans Mountain expansion, the toll rate is now at $87 a cubic meter, which translates into roughly 10 US dollars per barrel. And so the oil price difference you're getting from shipping abroad must overcome that additional cost. And that means under the long-term equilibrium prices, the margin that's left is really, really slim. So the business case is rather weak. And that's the reason why we haven't seen companies lining up behind it at this point.
I wonder why this project was fast-tracked then by the Canadian government, which I know you can't speak for the Canadian government, but you say the fast-tracking project approval process is questionable as well.
Yeah, there are two elements to the fast tracking. Fast tracking can mean different things. It can mean finding efficiencies in procedure, in speeding up a process. For example, there are separate provincial and federal jurisdictions that are involved, and that process could be streamlined. But if fast tracking just means getting rid of due process for reviewing environmental issues or trampling rights of indigenous communities, then I see this as highly problematic. We do need proper process before we approve any new project. If fast tracking means just doing away with due process and just rubber stamping projects, then we're paying for it long term because it leads to issues down the road. If environmental standards are compromised, then we may have leaks, we may have other issues down in the future that will be very costly. So fast tracking is no panacea for making projects happen. It just means that maybe is a priority, but whether it will be built depends on the economic viability, not whether a politician declares it a priority.
There is still a bright spot for Canada, though, Canada's future, Canada's economy. And you think Canadian LNG is maybe an attractive asset to the Asian market in the future? Is that where Canada should be really focusing its attention, is on LNG and exporting more of that?
The business case for LNG is quite different because it's built on long-term contracts and relationships one builds with partners or offtake agreements. And if these partners were willing to pay a risk premium for getting oil from other locations like Qatar and say, well, we're willing to pay a premium for oil from a more secure location like Canada, then I could see the business case for LNG improving somewhat because of the current circumstances. If there is a general assessment that the world is more risky and there is value in a more secure and diversified supply from locations that includes Canada. So there is such a case that can be made. However, to make LNG happen, we also need to look at the environmental dimension. And that means we can't just burn more fossil fuel for the liquefaction. It would mean we should increasingly turn towards electrification of the liquefaction. And that would actually mean a somewhat higher price. Can that price be paid by international buyers? That remains a question that determines the final investment decisions for several projects that have been proposed in British Columbia, namely the Xylozims project, as well as the LNG Canada Phase 2 project.
Okay, there's just so much to go over here and just not enough time. We're out of time, so we'll have to leave it there. Werner Entweiler, energy economist at the University of British Columbia's Saunders School of Business. Thanks so much for joining us. Still ahead, today's market drivers with Bloomberg's Guillermo Malero. That is coming up next. Stay with us. Welcome back. For some movers south of the border, we are now joined by Bloomberg Equities reporter Guillermo Malero. Guillermo, it's good to have you join us today. We'll start with NVIDIA, so a big company here paring some gains after announcing a couple of different partnerships. Tell us more about that.
Yeah, for sure. Thank you for having me. NVIDIA has dropped a little bit as the market has stayed open today, as Senators Elizabeth Warren and Richard Blumenthal have expressed antitrust concerns over their licensing pact with Grok. NVIDIA says it's just a licensing deal, it's not exclusive, and they're just getting some engineering talent from Grok that they're hiring over. But the senators are concerned that it's basically tantamount to an acquisition, which would further entrench NVIDIA's dominance in the AI chip space.
Interesting. We're also watching shares of Palantir today jumping, I believe, 5% after reports that the Pentagon was going to name their AI system as a, quote, program of record. What does that mean?
That's right. Basically, the program of record designation is just further entrenching it for official use. It's allowing the Department of Defense to use its systems across the whole department. Right now, Reuters have reported that its Maven AI system was already being used as the primary AI system of the U.S. military, but now having this official designation as a program of record will allow the Department of Defense to use it across the entire organization, basically. And that has analysts bullish, thinking not only that it will have more military use, but also that Palantir would be able to gain more federal contracts throughout all of government.
Okay, so good news for Palantir. We'll leave it there. Bloomberg's Guillermo Malero joining us live. Thanks so much for your time. Appreciate it. And that wraps up this edition of Trading Day. Thanks for watching.